Welcome to Money and Markets, Series 2, Lesson 3. This episode is called Credit Risk, Runs, and Deposit Insurance. In Lesson 2, you followed the timeline from overdue payment to bankruptcy. That was the borrower's story. Now we flip to the lender's side. Credit risk is the risk that the lender does not get paid. Not a vague worry. A specific financial loss. The principal you lent, the interest you were promised, some or all of it does not come back. But here is what makes credit risk different from the other risks you met in Lesson 1. It applies whenever there is a contractual promise to pay. Not just loans. Not just bonds. Any agreement where one party owes money to another. This lesson builds 3 ideas. What credit risk actually means. What happens when depositors lose faith in a bank? And how governments created deposit insurance to prevent the worst outcomes. Let us be precise about what credit risk is. Credit risk is the risk that a lender does not receive the full principal and interest as specified in the loan agreement. The loss comes from the borrower's inability or unwillingness to pay. Notice 2 things about this definition. First, credit risk belongs to the lender, not the borrower. The borrower faces other consequences like damaged credit and legal action. But the financial loss, the missing money, falls on the lender. Second, credit risk requires a contractual obligation. A bond pays fixed coupons and returns principal. That is a contract. If the issuer fails to pay, that is credit risk. But if you buy a stock and the price drops, that is not credit risk. Stocks do not promise you a return. Dividends are discretionary. There is no contract that says the stock price must go up. This distinction matters. Credit risk lives in the world of promises. Equity risk lives in the world of bets. Both can lose you money, but the mechanism is different. Now think about your savings account. You deposit money in a bank. The bank promises to return your principal plus interest. That is a contractual obligation, which means you, the depositor, have credit risk on the bank. But wait, banks do not keep your money in a vault. They lend it out to home buyers, to businesses, to other banks. Your deposit is the raw material for their lending business. You learned that in Series 1, Lesson 6. So what happens if those loans go bad? If borrowers default on their mortgages and the bank's assets lose value, the bank may not have enough money to return all deposits at once. This is not hypothetical. It has happened many times throughout history. Depositors hear rumors that the bank is in trouble. They rush to withdraw. The bank cannot pay everyone, and the institution collapses. That event has a name. A bank run. A bank run is credit risk in its most dramatic form. The bank owes money to thousands of depositors. Simultaneously, its assets, the loans it made, are worth less than expected. There is a gap between what the bank owes and what it can collect. If depositors withdraw in an orderly way, one at a time over weeks, the bank might manage. It could sell assets, call in loans, borrow from other banks. But bank runs are not orderly. They are panics. Everyone tries to get their money at the same time. And the bank, which by design holds only a fraction of deposits as cash, literally runs out. The first depositors in line get their money. The last ones do not. This is why trust matters more than math and banking. A bank can be solvent, meaning its assets exceed its liabilities on paper and still fail if depositors lose confidence and rush the door. The math said the bank was fine. The psychology said it was not. And psychology won. So governments created deposit insurance. The idea is simple. If the bank fails, a government-backed agency steps in and pays depositors up to a limit. In the United States, that agency is the FDIC, the Federal Deposit Insurance Corporation. It insures deposits up to $250,000 per depositor per bank. Here is a worked example. You have $100,000 in a savings account at a local bank. The bank invested heavily in residential mortgages. A downturn hits. Many borrowers default. The bank cannot return all deposits. It announces that clients will receive 40 cents on the dollar. Without FDIC insurance, you get $40,000. You lose $60,000. With FDIC insurance, because your deposit is below the $250,000 limit, you get the full $100,000 back. The FDIC covers the difference. That single mechanism, deposit insurance, is what makes bank runs far less likely in modern economies. If depositors know their money is protected up to the limit, the incentive to panic drops sharply. Deposit insurance is not unique to the United States. Many countries around the world have their own deposit insurance systems. The International Association of Deposit Insurers, or IDI, coordinates across borders. In South Korea, the Korea Deposit Insurance Corporation, KDC, insures deposits up to 20 million Korean won per depositor. Insurance policies are covered up to 50 million won. In the European Union, deposits are insured up to 100,000 euros per depositor per bank. The limits differ. The institutions differ. But the principle is the same everywhere. Governments decided that the cost of insuring deposits is lower than the cost of bank runs. Without insurance, every rumor becomes a potential panic. With insurance, depositors can sleep at night knowing that even if the bank fails, their savings are protected up to the insured limit. Not every account type is covered. Not every institution is insured. Read the fine print. But for standard savings accounts and CDs at insured banks, the protection is real. Now zoom out from deposits to any financial transaction. Every time two parties exchange money for a promise, there is a counterparty. And every counterparty carries credit risk. When you buy a bond, the issuer is your counterparty. Their credit risk is your risk. When a bank lends to a home buyer, the home buyer is the bank's counterparty. The home buyer's credit risk is the bank's risk. When two banks trade in the foreign exchange market, each bank is the other's counterparty. If one fails mid-settlement, the other absorbs the loss. This last example is exactly what happened with Bankhaus Herstatt in 1974. We will tell that full story in Lesson 5. The point for now is that credit risk is not just about deposits and loans. It is about every contractual relationship in finance. Wherever there is a promise to pay, there is a counterparty. And wherever there is a counterparty, there is credit risk. How do lenders protect themselves beyond insurance? 3 layers, which you have now seen across this series. First, collateral. The borrower pledges an asset. If they default, the lender seizes the asset. A house for a mortgage. A car for an auto loan. Collateral reduces the lender's loss given default. Second, credit assessment. Before lending, the bank evaluates the borrower. Income, employment, existing debts, payment history. The result is a credit score or a credit rating that determines whether to lend and at what rate. Third, diversification. The bank does not lend all its money to one borrower. It spreads across thousands of loans, different sectors, different regions. If one borrower defaults, the loss is absorbed by the income from the rest. These 3 layers, collateral, assessment, and diversification, are the lender's defense against credit risk. None of them eliminates it entirely. But together, they reduce the expected loss to a level the lender can price and manage. Credit risk turns deterministic math into something uncertain. In Series 1, you learned future value, present value, discount factors. All of those formulas assume the payments actually arrive. The math is clean because the inputs are known. Credit risk breaks that assumption. Now, each future payment has a probability attached to it. Maybe it arrives in full. Maybe it arrives late. Maybe it does not arrive at all. That uncertainty is what makes credit pricing interesting and difficult. The credit spread on a corporate bond, compared to a government bond of the same maturity, reflects the market's collective estimate of that uncertainty. Higher perceived default risk means a wider spread, which means a lower price for the bond. This is the bridge between Series 1 arithmetic and Series 2 judgment. The formulas stay the same, but the inputs become probabilistic. And managing that probability is what credit risk is about. 3 takeaways to carry forward. 1. Credit risk is the lender's risk. It requires a contractual obligation. Bonds have credit risk. Stocks do not, because stocks make no promise of return. The distinction matters. 2. Bank runs happen when depositors lose confidence faster than the bank can raise cash. Deposit insurance, like the FDIC in the United States, prevents runs by guaranteeing deposits up to a limit. $250,000 per depositor per bank. 3. Counterparty risk is everywhere. Every financial transaction involves a counterparty, and every counterparty carries credit risk. Collateral, credit assessment, and diversification are the 3 layers of protection. Next lesson, we look at bonds, the institutions that hold them, and why financial regulation exists. I will see you in Lesson 4.